Good afternoon, everyone. Good morning. Welcome to our on-fifth panel on Bill White's 5 considerations for a sustainable recovery. Thanks very much for joining us. We're very pleased to have you with us. I'm John Orchard, on-fifth CEO, and we're delighted to have you with us. This very important discussion on if and how central banks, finance ministries, and policymakers might use the current crisis to fix a number of long-running and intertwined problems, economic, social, and environmental, some of them potentially being made worse in the medium term by the immediate rescue measures. Firstly, a quick bit of housekeeping. This isn't a Chatham House rule meeting. In other words, it's on the record, and indeed it is being recorded, and it's also being live streamed on YouTube, where of course you're watching now. I would encourage you to send in questions as we go. We'll gladly thread those into discussion after we've been going for 20, 30 minutes or so. We really welcome that. My colleagues are going to show you now in the chat functions where you should put your questions, and they will be feeding those to me as we go. Plenty to talk about, so let me go straight on to introduce our excellent panel this afternoon. We have, of course, Bill White, whose paper is the basis for the discussion. He's going to very briefly summarize its key points in a moment, and my team are posting a link to it also. on-fifth published it this morning. Bill's currently a senior fellow at the C.D. Howe Institute in Toronto, where he's beaming in from today. Until 2018, he was chairman of the Economic and Development Review Committee at the OECD. Before that, he had senior roles at the BIS, Central Bankers Club, which he graduated to after spells in central banks, Canada and England. And he's also advised the Canadian Ministry of Finance and worked in multilateral groupings of government officials, central bankers and academics. So Bill, thank you for joining us and thank you for your paper. Looking forward to discussing the points in it in a moment. We're very lucky to have a governor from the ECB system with us today in the form of Robert Holzmann, an Austrian economist, maybe in two senses, and since September 2019, governor of the Austrian Central Bank. And before that, he held various positions at the World Bank and other international organizations. Pierre Siklos is a professor of economics at WLU, widely cited economist and academic, specializing in macroeconomics with emphasis on the study of inflation, central banks and financial markets. Pierre's held a number of academic posts, and since 2008, he's chairholder of the Bundesbank Foundation of International Monetary Economics at the Freie Universität in Berlin. And that year, he also became a senior fellow at the Center for International Governance Innovation. My colleague, Danai Kirakopoulou, is our chief economist and director of our research department. Danai is a PPE graduate from Oxford. As many of you know, typically that's a path to being in the British government, I might add. However, that's their loss and our gain. Before working here, Danai was a managing economist at the CEBR. In addition to oversight of our research output, so in itself a big job, Danai is also spearheading our sustainability work. We're going to talk about some of that later today. And many of you in the audience will be familiar with her initiatives in that area. Danai founded on-fifth's Gender Balance Index, which looks at staffing and policy in central banks through that lens. And Danai, importantly, is also just launching our SPI, or Sustainable Policy Institute, which we hope will do important work at convening the right discussion on ESG regulation, standards and data in our sector, especially central banks. And that opens on Monday, so do get in touch if you want to come to the inaugural session on that. We'd be very delighted for you to attend. Now, before I start our discussion, I want to run a very quick audience poll. So Ben, if you could mount the poll for me, please. I'm going to ask this now and then at the end and see if the discussion changes your mind. So Ben, please pop up the poll, please.
Ik heb maar vragen op de muziek.
So if you could all vote now. It's a deliberately stark and simple question. Those are often the best for the purposes of these discussions. So please vote now. We're going to ask again later and see if the discussion changes the balance. When you're ready, Ben or Ellie, if you could reveal the results. Seems very, very evenly balanced, suspiciously evenly balanced at the moment. Good, okay, so let's see. So very, very evenly balanced. Perhaps that means they've got it right. So let us crack on with the discussion. Ben, if you could drop that away, and we'll ask again a little later, that would be great. So, Bill, why don't you, well, the audience will soon see why we've asked that question, I think, when we hear what's in your paper. Give us a very quick review of the main points of your paper, and then we'll crack on and see if we can solve some of the issues that you raise. Over to you, Bill.
Well, thank you, John. And can I start by thanking both OMFIF and the Balsillie School of International Affairs for having published my paper. Without trying to be alarmist, I guess the premise of the paper is that the global economy, and I think humanity itself, is in a more precarious situation than most people realize. And the fundamental point is that prior to the pandemic, there were a lot of problems developing in the economic system, in the environmental system, and in the political system. And my worry that I raise in the paper is that the pandemic really is a kind of trigger that might sort of lead to an unbalancing of those other systems that were already suffering from preconditions or were otherwise stressed. My paper remains hopeful that in spite of these difficulties that we can get out of this mess in these various systems. But to do so, we'll have to answer 5 questions, and the paper really runs through each of them sort of very briefly, and I do try to present some possible answers. The first question is, what are the preconditions that were created by bad policies or policies in the past that didn't consider the longer run implications of their being put into place? So those are the kind of policies that we will have to try to avoid going forward. So question number 1. Question number 2 is, what other stresses seem to be coming down the road that are already sort of predictable? And there, I guess, the environmental damage, I have concerns about demographic change, that many of the sort of the beneficial demographic changes are now going into reverse. Anyway, we need to think carefully about what other shocks are coming down the line. The third question really is, what would a more sustainable economy, global economy, look like? And there, without sort of giving away all of the conclusions, I think a more symmetric set of macro policies that leaned against the good times as much as it leaned against the bad would be a helpful characteristic of such a sustainable economy. The fourth question is, if we know where we want to go and we know where we currently are or likely to be, what do we need to do? What policies could get us from where we are to where we want to go? And then the last question, of course, is actually not so much an economic question as a political question. John Kenneth Galbraith many years ago quipped. He said, politics is not the art of the possible. It is choosing between the unpalatable and the disastrous. And the question is, if all of the policies that will be required to get us from where we are to where we want to go are costly in one form or another, how do we convince the politicians to provide the leadership to choose the unpalatable over the disastrous? And I would say, with respect to all 5 of these questions, I do not profess to have with certainty all the right answers, but I can say with a bit more confidence that I hope I've asked the right questions.
Thank you very much, Bill. And we're not here about to ask exactly those questions, but we are going to cover exactly those themes. We want to come onto the broader issue of sustainability in its ESG sense. That's very important and raised in your paper. But first, want to look more narrowly at the economy. I know they're very much linked. I don't want to start with essentially the question that we just asked the audience, which is whether we believe that the current super low interest rate environment is harmful in the medium term, and if so, why? I know that's putting you on the spot, Governor Holzmann, but I'd like to turn to you with that question, please.
Thanks. I think it is a very important question. I think all of us agree that low interest rates at a time of a crisis were needed in order to deal with the shock. But many of us, I think, believe that in the medium, in particular long term, low interest rates, in particular negative interest rates, are harmful. And they cover all three economic areas. They cover the area of allocation, because low interest rates risk damaging productivity, the risk damaging the motor of economics, which is creative destruction. They are damaging because they risk to create inflation in the asset area, the bubbles on shares and on property. But also, given this development, there is creating a lot of inequality, both at the level of assets and the level of income. And what we have seen in recent years is that these side effects becoming main effects, and for this reason we have to think about how to deal with them. Okay,
thank you, Governor Holzmann. Of course, if rates were higher than they were, that would put a strain on debt sustainability, and we'll come on to that in a moment. Pierre, what's your view? Do you think the current super low interest rate environment is damaging medium term?
Well, I'm going to assume first that by medium term you mean something in the order of 2 to 5 years.
Yes,
and it's worth reminding people,
longer, 5 years, say.
All right. It's worth reminding people, of course, that we've had low interest rates, maybe not as low as they are now, but for quite some time. And it's more important to remember that when central banks and other officials made the argument for these low rates or super low rates, one was that this was to help create conditions that would return inflation to within some target and put a floor on the drop in economic growth, or help create the conditions that would return the global economy to more normal growth rates. And certainly, as Governor Holzmann mentioned, in a crisis, this kind of policy can work, but it can only work can't work for a long time. And that's one of the reasons why in the US we've had QE1 to QE3, but they've stopped talking about higher numbers for QE because I think there was a realization that it can work, but not for. And I also would the government to be sort of one of the participants in the European Parliament monetary dialogue in about 10 days' time, and this is one of the very questions that's being posed to us. So briefly, the answer is it can work for a time in a crisis, but you need an exit strategy and to plan for an alternative type of regime than just keeping interest rates lower forever.
Thank you, Pierre. Denai, obviously you sit in on lots of our discussions with lots of current and former central bank officials. I think it's fair for me to generalize that I hardly ever hear discussions about rates going significantly where they are now anytime soon. Would you say that's fair?
Yes, I think asking the question of whether low interest rates are harmful for the medium term, we have to put it in some sort of context, because they are just one policy tool available if we look at what we want to achieve, and we have to compare it also to the counterfactual. if interest rates are not low, can we achieve what we want to achieve with other tools? And what we've seen in the past decade or so is that other policy levers have not moved. And Bill also highlights that in his paper in terms of the over-reliance on monetary policy. So in that context, if we didn't have other policy levers moving and interest rates were also not kept, or monetary policy not kept as accommodative as it has been, we would probably be in a worse place. Yes, there are negative side effects. Yes, there is the need to be able to return back to a more normal level of interest rates, as Pierre was saying, but at the same time, given where we are, given that fiscal policy has not been used as it should have been, and we've had this lack of balance, it's a preferable outcome to not supporting the economy at all. I think the other thing to say is that, yes, they are linked to the price stability mandates that a lot of central banks have, but do we really measure inflation in the right way? I mean, the financial sector has been seeing a lot of asset price growth. There's been a disconnect between financial markets and the real economy. And to that extent, we perhaps are not focusing on the right policies in this way. I see that Bill in his paper also say that an over-expansionary fiscal policy could also hide some dangers, but perhaps we can discuss that later as we go along.
Thanks, tonight. Bill, to put back to you a version of the Galbraith quote from earlier, super low interest rates, the lesser of two evils. You were talking about difficult and catastrophic. What's your view? What might be the alternative? We know that it's sponsoring an accumulation of debt, which is one of the things you address in your paper. But what could be done differently?
Well, there's a distinction between what could be done differently going forward and what might have been done differently in the past. And I think Danai has sort of made reference to the fact that we could have used other policy levers more. And I think there's a growing recognition that we withdrew from fiscal stimulus too quickly after the great financial crisis began, and that we relied on more of the same monetary policy. And then, of course, still more of the same monetary policy. I think that that was the wrong thing to have done. Fundamentally, at the moment, we're at a situation where if you think about monetary policy and how it works, it becomes less effective over time as the debt levels that it generates build up and tomorrow becomes today. So monetary policy becomes less effective with time. The difficulty is that the unintended consequences become more important over time. So if you drew sort of two curves in the air, they would intersect at a certain point where you would say monetary policy is doing more harm than good. And I think that that's the point that we've come to. It's a little bit like Milton Friedman. Pierre raised the question of what do you mean by the medium to long term? Someone once said to Milton Friedman, but of course, money only generates inflation over the longer term. And Milton Friedman responded, I have seen the long term, and it is now.
Thank you. I don't want to spend too much time on this today, but the Fed has just changed its inflation targeting. Is that not perhaps the route out? So if eventually inflation ought to follow, at which point you can put interest rates back where they ought to be. Would you agree with that?
Who, me?
Bill? Yes.
The problem with what the Fed has done is that it rests fundamentally on an economic model that I think is flawed. And the idea is that the only thing that really matters is the expectations. And that if you can convince people that inflation is going to rise, that they will behave in a way that the inflation does indeed rise. To me, unfortunately, it rings too much of Tinkerbell, which is, of course you can fly. All you have to do is believe. And I was at Jackson Hole, I think, way back in the late 1990s when Yutaka Yamaguchi from the Bank of Japan was asked why they didn't have explicit inflation targets. And his response, I think, was very similar to the one I would take today, is that you can only convince people that inflation is going up if you have credible means to ensure that it will go up. And the difficulty, as Pierre has referred to, is we've had 20 years almost of them trying to do that and not being able to do it. The interest rates have now gone to zero. the other methods that they have been using have proved inadequate to achieve the objectives that they want. So my question would be, why should anybody believe them? And as you have been following, I mean, there was an article even this morning in the FT, people calling for more clarity about what it is that the Fed intends to do in order to ensure that it can meet the new targets that it just laid out. That's the question.
Okay, and I'm sure we'll explore that more. I mean, there are certainly voices in the financial community, asset managers, economists, and so on, people in the central banking community, Germans who think that inflation will follow from these kinds of policies and become unmanageable sooner than we think. Maybe we can go back to explore that in a minute. One of the things that is de facto holding rates down is concerns over debt sustainability. We've seen what happened to Italian sovereign financing costs, which were then corrected, I suppose, by ECB actions, notwithstanding they said they weren't doing that. So let's talk a little bit about debt sustainability before we go back then to central bank policy. Perhaps we can start with you, Governor Holzmann. Debt to GDP ratios are at the heart of the Maastricht criteria on which the euro is built, currently suspended. Do they matter if the cost of money is negligible or even negative, debt to GDP ratios?
This ratio matter definitely lesser if and as the interest rate is lower, but as this will not be the case indefinitely, any higher level becomes a major threat. If you have a country which has a debt to GDP ratio of 3 times of the Maastricht criteria, then of course you are in a problem, and any kind of inflationary policy, if successful, puts of course a threat then on the sustainability even more. And there are enough calculations out that show that in the short run, yes, sir, inflation may be helpful to reduce the debt to GDP ratio, but if and as nominal interest rate are bound to rise afterward, then it becomes dangerous. The way out, and the only way out, is to have reforms which are able to create the growth, the real growth rate, to bring the GDP level upper. And this is the way what has happened in some countries recently. They were able to decrease the GDP ratio. But even if you look at Italy, which has a phenomenal high level of surplus, of primary surplus, with no growth for the last 25 years, it's almost impossible to reduce the GDP ratio.
And we'll come back to the euro area in a moment. So there's a huge disparity in debt to GDP ratios there. Pierre, what do you think? There used to be a magic threshold of 80% that's been set aside in the face of super cheap money. Debt sustainability seems in one way to be in a way of normal interest rates. What do you think? Do we need to fix the indebtedness before interest rates can be normalized? Does it matter, or should governments fill their boots while they can in order to invest to create growth?
Well, the current thinking, of course, is largely motivated by this simple arithmetic that the relationship between real interest rates, that is, interest rates after you take account of inflation and economic growth, favor more debt. But what is sometimes forgotten is that there's a of sorts, which is that economies become less resilient. And take the example of Germany. One of the reasons Germany could step in fiscally very quickly and in a fairly sizable manner is because they were fiscally relatively more responsible, and they had the space, the fiscal space to step in when there was a crisis. And you know, it's worth adding that we used to think that crises were rare, but it wasn't too long ago we had the so-called great or global financial crisis, then the Eurozone sovereign debt crisis. Now we have the global health crisis, and each time we keep putting off the eventual problem that we have to deal with the debt. But there's another aspect, which is that, and this I think is relevant to the European case perhaps more so, but not just the European case, which is one of the reasons I think that those who created the single currency wanted a debt to GDP ratio type of metric. It was a way of creating a level playing field. And so when you have countries racing to build up debt, this potentially also hurts international cooperation. I just want to remind you that for years there were complaints by the large economies about economies running current account deficits or surpluses persistently. And so eventually they came to some kind of understanding that they have to monitor these things. Didn't amount to very much. So the worry is that the same problem might be repeated when it comes to debt sustainability. So we can't, as Bill points out quite correctly, we can't keep putting these big decisions off.
Okay, we'll come to how on earth we could fix that in a moment, because that will be yet another set of decisions between unpalatable and catastrophic. Perhaps we'll come back to that. Denai, there is a debate, I think it's fair to say, in the economist community between those who say just keep borrowing until the inflation reappears, don't worry about the debt to GDP ratios, versus people in the Chancellery in Germany we spoke to 2 weeks ago saying, we told you so. If we hadn't got down to a debt to GDP ratio of 65%, we wouldn't be able to solve our own problems and help solve those of others. Where do you think economists stand on that debate at the moment?
Thanks, John. Certainly sitting here in Athens, that sustainability analysis is recognizably a very complicated issue. I think we've learned in the past 10 years or so that it can be an economic issue, but also a political one. I think debt to GDP ratio definitely matters, but what we should remember is that it's a ratio, that the numerator and the denominator all matter in terms of where it goes, and growth is important as well. GDP is important, so having pro-growth policies also helps get there to sustainability. I think what we've also learned is that there's so many parameters to measure debt sustainability. It's not just the crude debt to GDP ratio, it's also the funding cost, the ability to repay, the maturities, who the debt is owed to. Is it owed to official creditors? Is it owed externally or domestically? And I think what we've learned there is that it's more an issue of liquidity, and most bankruptcies that we've seen can be for very, very low levels of debt. It's just that when you lose that liquidity and you're not able to repay, that's what you get. So the ability to repay, the funding costs are much more important than the crude debt to GDP ratio. Of course, it's an important measure and metric to monitor, but I do think that the SGP, as you mentioned, needs to be rethought. We need to have a more nuanced understanding of these economic conditions.
Okay. Thank you. If we're forced to choose between, we'll come back to restructuring the debts of heavily indebted countries. That seems to be the unsayable thing that needs addressing. We'll come back to that in a moment. If Bill, your suggested current policy won't succeed in creating inflation, notwithstanding the Fed moving the goalposts on targeting, but if it did, which is the lesser evil, the rising cost of servicing these unsustainable debts, or the erosion of those debts through the inflation that would be created, in your view?
Well, it goes in a certain sense. It goes back to Pierre's earlier comment about the simple arithmetic about G and R. That is to say, the nominal growth rate of the economy and the interest rate. If the nominal growth rate is nominal growth rate of the economy is greater than the interest rate, well then over time the debt service burden gets less and less, and that's good. But conversely, it might go the other way, and that's bad. Okay, that's fair enough. The underlying question about all of this, of course, is really the question of inflation. And in my earlier comments, I said that I thought it would be very difficult for the Fed to create inflation, and I continue to believe that. Having said that, however, if you have a situation in which the government is running big deficits and the central bank is financing them, and the situation goes on long enough, then you can get into a situation where you have worries about fiscal dominance. And in the end, that will end extremely unhappily. And some of the viewers may be familiar with a very famous article written by Sergeant Wallace back in the early 1990s called Some Unpleasant Monetarist Arithmetic, that the fiscal if the fiscal situation is bad enough, it will blow away even a resolute central banker. Okay, that's the theory. An old friend of mine from the University of Basel, Peter Bernholz, has actually written a book which is called Monetary Policy, Inflation and Monetary Policy Regimes, in which he gives the history to back up the theory. So we have here a highly sort of, what's the word, nonlinear possibility. It reminds me of the old joke about the guy who jumps out of the 20th story window. And as he passes the second floor, someone shouts out, "How are you doing?" And he says, "So far, so good." We are not used to thinking about nonlinear processes. And the models that the economists use do not, generally speaking, incorporate nonlinear processes. But unfortunately, the way the world works is profoundly nonlinear. And we should be always thinking in our mind about these bad outcomes that in fact might be disastrous outcomes, and what steps you should reasonably take to try to avoid them. So
okay.
That's sort of where I think we're at.
Okay, thanks, Bill. Governor Holzmann, I don't want to put words in your mouth, but I don't think you're wildly keen on super loose monetary policy. We were talking about that at the very beginning. If it were to succeed in generating inflation in the Eurozone, I know that's many people would contest that it will, given on the statistics, but if it did, would you favour that as a way of solving, for example, the indebtedness of some Southern European countries?
I think inflation has always been a main instrument in order to deal with debt. And we don't have to believe now in high levels of inflation. If you take the current level and add 2%, it would make only a huge difference on the arithmetic, the unpleasant one, over a short period of time. So, and here I hold that the moderate level of inflation has made life easier in many countries and would also make life easier, particularly in southern countries, but they have been used to much higher inflation before, and where dealing with public debt with some inflation would perhaps be a way out because this financial repression has had tradition and it worked.
Thank you, Governor Holzmann. Pierre, would you favour inflation as a means to solve some of the indebtedness, not just in Italy, but the US has an enormous debt pile as well, for example?
Since you mentioned the US, there's a favorite saying that's expressed by our American friends, which is inflation is taxation without representation. And it's worth also remembering that we've had low inflation in the advanced economies for at least over 2 decades. Most, certainly my kids don't know what high inflation is, 4, 5, 6%. Even emerging markets have dramatically reduced inflation rates. So when I was young, it was easy to say, well, we'll have a little bit more inflation. And that was, if not accepted, it was tolerated. I'm not sure if politically there is as much tolerance for using inflation to get rid of this problem. Certainly there'll be some more inflation. In fact, there are quite a few economists who talk about higher inflation, but even those economists talk about, at least in advanced economies, inflation rates of maybe 4%, which is a far cry from the double-digit inflation rates that we're used to seeing in the 60s and 70s and early 80s, if not before. So it's going to be a difficult sell to use inflation as a way out of this problem.
Okay, thank you. I'd like to widen out the discussion in a moment to the broader themes. Bill's paper talks about much broader issues in terms of sustainability, environment, health, and so forth. So I'm going to come on to that as an objective of the recovery. Just before we move on to that, I want to look at the least painful way of debt restructure. We've talked about inflation. What about, for example, a significant restructuring of debts, Governor Holzmann, for certain heavily indebted European countries? I mean, some of them, you could argue, because of the euro, will struggle to ever get rid of them unless there's something more radical done, like restructuring of the outstanding bonds. What's your view?
Well, my understanding is that yes, restructuring could be one way out. Yes, inflation could be one way out. But at the end of the day, the biggest contributor to coming down with the inflation debt to GDP ratio is to boost growth, to boost productivity. Because if you were to do a restructuring of the debt, if you continue with the same economic policy as before, you only delay it, and a few years later, you're in the same situation. So whatever you do, if you want to get out and come to a more sustainable path, you have to do reforms. The rest are only delays, but no solutions.
Okay, fair enough. Bill, Paris Club for Italy and things like that, what's your view? That there seem to be few other ways to narrow the debt to GDP ratio of a country such as Italy with that of, say, Germany?
Well, I think that there will have to be consideration given to debt restructuring for many countries. I'm not sure that Italy would be necessarily one of them, but certainly many of the highly indebted poor countries where the debt ratios have been going up very substantially. The IMF has already called for a significant effort towards restructuring. There, I think there will be some efforts required. I think going forward, a lot of effort needs to go. We need to think at least about what the possibilities are for debt restructuring, and the WP3 at the OECD, the G30, the IMF. All sorts of people have noticed the fact that our administrative and our judicial proceedings for dealing with debt, both public and private, are inadequate. And they need to be looked into with a great deal of care and with some urgency, it seems to me, because in many cases there will be an inability to service those debts. And I'm thinking particularly now on the private side, corporate side. And as we all know, if the debt service cannot be managed, it will not be managed, and it will not be managed in a disorderly way. And that in itself will create still more problems. So I think thinking about this debt restructuring thing as a real issue and as a way out of some of the problems that we face is something that we should give more consideration to.
And what would you say to the asset management companies that are on this call saying it's all very well for you to say that, but we're sitting on portfolios of sovereign bonds which are supposed to be safe? We can't simply write them off. We're looking after people's pensions here. What would you say to them?
Well, I think what I'd say to them is what Bill Rhodes used to say when he used to get the bankers around the table in New York. And he would say to them, gentlemen, do you want 50 cents on the dollar or do you want nothing on the dollar? Because 100 cents on the dollar is not on the table. And so I go back to the point that I just made. If debts cannot be serviced, they will not be serviced. And the question is, do you want that to happen in a disorderly way, in which case you take nothing away from the table, or do you want it done in an orderly way, in which case you can manage to get the maximum amount that it is possible for the country or for the private creditor to pay? These are unpalatable. I have absolutely no doubt about that, particularly because it's not just rich folk, it's pensions of middle-class folk that are on the line here. I have no doubt about the political problems that this poses, which is the reason why I try to address it, albeit briefly, in the last part of my paper.
We could come back to some. You could, of course, push them all into central banks and leave them there, but we'll come back to that in a moment. Pierre, what for you is the least painful way of solving unsustainable debts, whether in the Eurozone or more importantly, perhaps in emerging market countries, particularly those not borrowing in their own currencies?
Well, I think you try to first set a framework defines the starting point. But there has to be recognition, and that's why sort of the Paris Club may be one way to deal with this, which is that you recognize that the same form of debt restructuring will not work for all countries at all times. So that's the first thing I would point out. But I would then say that it's not enough to think about debt restructuring, and to bring back one of the points, to paraphrase, if you like, what Bill was trying to say, which is that we're headed toward a perfect storm, and debt restructuring will help, but it won't fix the problems alone.
Good, thank you. We've had a question in from the audience on QE and the sustainable recovery, which I think is worth looking at. QE is said by some, if not many, to exacerbate problems. Governor Holzmann mentioned earlier, you get asset inflation, which helps asset owners and therefore exacerbates income inequality, wealth inequality. What about green QE? So if QE is here to stay, the questioner asks, for the foreseeable future, can we use it as a catalyst for sustainable growth? So what about green QE? So could I turn to you, Governor Holzmann? What do you think about that? And I know it's somewhat in discussion already.
As regards the greening of the economy, I think there's a major role for central banks to assure the financial sustainability of the system and make sure that the financial institutions are risk-proofer against the increasing level of exposure to brown companies compared to green companies. And this is something I think which most or all central bankers will support. When it comes to the greening of the economy through greenwashing, through QE, I think here the opinion is more splitter, because the problem what we have is, on the one hand, a question of to decide what is a green asset which should be bought, but more importantly, once you have it on your balance sheet and you have it there, if it's a small amount and you want to pay it back, how you're doing with it. But the most critical part is it would become a too easy part of financing the reform towards a green economy. I think there should be no competition on the level of prices in order to get the prices down for assets which have a green appeal. I think if and as green enterprises, green production allows to pay a higher rate of return, it speaks for themselves. And I think this is something what's the discussion before the green part of socially sustainable development has always shown, that there is a need for a framework which offers the right transparency and the right prices.
In other words, I think you're saying, Governor Holzmann, by and large, we can leave this to the private sector to address. Would that be a fair summary?
This is a fair summary. I expressed myself a bit more complicated to make my point.
Yeah, thank you. We've done a lot of work on this, specifically you have. We published that report earlier in the year, which looked at a range of prudential regulatory measures being taken by central banks with respect to ESG goals. What do you think, and what are you hearing in respect of green QE and other measures by central banks to sponsor a green recovery or a sustainable recovery, setting aside whether that's a good idea or not, which we'll come back to?
Yeah, I think what we hear a lot from central banks is that there is this very important principle of market neutrality when they operate in the economy, when they undertake certain policies, including quantitative easing, that this shouldn't be done to distort the economy in any way. And so it should reflect the broader market structure in terms of what kinds of assets they purchase, and then within these assets, what particular securities they purchase. What this ignores, of course, is that if we keep purchasing according to the market structure as it is, at the same time as recognizing that this is an unsustainable market structure, at the same time as recognizing that there are risks to portfolios of the institutions these central banks supervise, then the same applies to their own portfolios. So they're subject to the same risks. I think that principle of market neutrality needs to be thought in that context. And if we recognize that there is a role for central banks to support a more sustainable economic model, a transition to a greener economy, then having QE programs that are not aligned with that is a contradiction. And that's what we're starting to see from some of the central banks that are members in the OMFIF network in terms of taking this as a way to look into their own portfolios. The Network for Greening the Financial System, Central Banks Network, published a paper in October last year looking at how central banks can green their reserves portfolios, for example, their pension portfolios. And that's something that is on that side. But on the QE side, there is less appetite precisely because of that principle of market neutrality, which I think is starting, some central banks are starting to rethink.
Thank you, Dinah. Pierre, what do you think? We've talked about the problems involved in hyperactive central banks working in the place of governments for a while. Can that be made into a good thing, particularly to offset the damage of that you could argue has come from asset inflation with green QE, as our questioner asked? Do you think that's a wise thing to do?
Well, the simple answer is probably no. I think central banks are reluctant to being asked to pick winners and losers when it comes to what might best stimulate growth. I suppose the one thing that could be done is when the mandate or the remit of the central bank is negotiated or renegotiated, that there's some clarity about where accountability lies. The only positive thing you could say, I suppose, about green QE is that it's at least somewhat, or it can be somewhat transparent. But of course, the devil's in the details, as I think Governor Holzmann and Dene sort of hinted at, which is that we talk about green QE or green investments as if it's obvious what it is. It means different things to different people. And that also serves to complicate the task of the central bank. Look, central banks are already, some feel overburdened. This adds to their burden. And I think at this stage, they have enough on their plates.
Okay, thank you. Bill, would you agree central banks have enough to worry about without leaning into ESG regulation and having an impact on asset prices accordingly? What do you think?
Well, I think that with respect to both the collateral question and the QE question, that central banks should be taking into account the possibility that the market prices may themselves not reflect the externalities of environmental damage, et cetera, et cetera. Having made that point, the central thing is the environmental problem is going to be with us for ages and ages. And when you think about collateral policy and QE policy on the part of central banks, these things are essentially temporary in principle. So they are not a permanent response to what is going to be an ongoing problem. They have a role to play, I think, but it's a minor role. And my worry would be that the governments, in the same way as they've depended upon the central banks to pull the irons from the fire and to do all of the heavy lifting over the course of the last 10 years, as opposed to themselves having to do some tough things. In the same sort of way, they'll say, well, the central bankers have got the environmental thing under control, so we don't have to do hard things. And one of the hard things that the governments really have to do is we need a carbon tax. And I think virtually every economist is agreed that we need a carbon tax. Many say that some of the money should be given back in a progressive fashion to ensure the political viability of that policy. But the governments need to do some hard things here to deal with the environmental problem. The central bankers have a small role to play. They have got a good reputation that will lead others to behave in a proper fashion. But this is really something for governments to do. And there are hard decisions to be taken, and they should take them.
Okay, so I think the consensus here is that this is one for lawmakers and fiscal authorities primarily, before it's something for central banks. Certainly, we're watching that theme very closely. Denai and her team are regularly polling on that. And we've had a related question, actually. It's given the changing mandate of the Fed, it's impossible entirely to divorce central banks from a social mission. So we had a question from Thomson Reuters, which is, what is the broader implication for global central banking of the Fed's reinterpretation of its inflation target? We talked about that a little bit earlier. For one, the emphasis on low-income workers shifts Fed policy into the realm of social policy. And the implication that rates will rise slower creates a persistent drag on the dollar. It's a very interesting point. In other words, there is the social mandate is perhaps causing issues with the core mandate. What do you think about that, Governor Holzmann? Would you agree?
I have to say I'm happy that our mandate is focused on monetary targets, on inflation rate, and doesn't have a mandate which allows to move far outside, because here the trade-off would become much more complicated. We are still allowed to engage in other areas, but we're not fixed on one of the targets, because employment is still a very variable concept, which may be interpreted very differently, and this makes things harder. So I have to say the more recent reinterpretation, my senses will not make the life of the Fed easier, and I'm happy I don't have to deal with that.
Thank you, Governor Holzmann. Pierre, what do you think about that question, that the mandate to look after lower income people could potentially drag on the dollar? It's an interesting thesis. What's your view? And should that be true?
Well, I don't think we know yet enough about the connection between those two to say anything with a lot of clarity. But when it comes to sort of the social aspects, I think as someone who's sort of studied what central bankers say and do, it's clear that in the last few years they've expressed themselves more often about the social issues and that the economic problems. I see that as a way of two things. One is a recognition that they know that there are other things to worry about. And in a way, as a way of diplomatically pushing back against the fiscal authorities to say, look, we can do our best to ensure economic resilience and conduct policy in the best possible fashion, but we can't be the solution to all problems. So now, of course, also when it comes to the dollar, keep in mind that I come from a country where we've long felt, perhaps longest than any other country in the world, that the floating exchange rate regime, while not perfect, works best. And so we try not to worry too much about the dollar. But there are other areas too, which perhaps is a little bit outside of your question, that where the social aspect of central banking comes in, and that's the current ongoing discussion about the introduction of digital currencies as a way to improve financial inclusion. It's not the objective first and foremost of central banks, but it's a fallout from these developments. So I think it's quite proper for central banks to show awareness of these issues, but beyond that, the actual formal decisions, or some of them, have to be taken by the elected authorities.
Thank you. And of course, OMFIF is doing a lot of work on the digital money side, so do come to us for that. On currencies, I have to say, our most read articles are all on currency and not on interest rates at the moment. So the currencies seem to be the new interest rates as far as central bank think tanks are concerned. I just want to put a counterpoint to your argument. If we say that it's not necessarily central banks' jobs to worry about these things, what if you were to say that the problems are somewhat a function of what they've done? So people do argue that QE has exacerbated income inequality. So should they not try to correct that problem, which descends from the other problems that we've talked about? What would you say to that?
Well, if they had the tools to do so, to rectify past mistakes in this respect, I would say, yes, they do have a responsibility. And in fact, one of the ways in which I interpret what the Fed has decided to do is, without admitting to doing so, is to say what we did previously didn't work, so now we're going to try something else. We're not sure if it'll work, but we'll give it a try. But also remember that if there is going to be a future problem with inflation and excessive debt levels, it's very likely that the people around the table making decisions will not be the ones who are there right now. So this is sort of a version of kicking the can down the road, so to speak.
Yeah, seems to be an underlying theme. Bill, what do you think about that? The central banks are being asked to fix problems that perhaps they've also created.
Yes, but I think I would agree with Pierre. The question is, do they have the tools to rectify the problems that they themselves have created? And I think the answer is no. We are, I mean, this is a characteristic of all of these systems. Everything is path dependent. You start from where you start from. You'd like to start from someplace else, but you start from where you start from. And I don't think really central banks have got the tools required to deal with the inclusion question. It is important to note going forward that QE and the effect that it's had on financial asset prices have clearly had an effect on wealth distribution. On income distribution, the central banks, of course, have fought back by saying the best way to get better income distribution is create more jobs, which is what they have been trying to do. Although, as I guess both Pierre and I and others have implied, with growing ineffectiveness over time. So what I worry about the most really with the Fed's recent turn, and I mean, let's be perfectly clear about this, they are now focusing on employment and not on price stability. So in terms of the ordering of the priorities, it is now clear what their priority is, and it's different from what the priority has been over the course of the last number of years. I think in the short run, that may do no great harm, but the real worry, as I said before, is that some combination of an unresolved fiscal problem together with the continued expansion of the central bank balance sheet may in the end lead to a kind of tipping point and a problem. And if the US has a problem, a form of dollar crisis, then of course, and Pierre's alluded to the currency question, then we all have a problem because the international financial system is still basically a dollar-based system. So a crisis in that realm is going to have big effects on us all.
Could I summarize you as saying that you think that the US is still on an unsustainable path, in summary?
Yes, clearly.
Okay. I think, Governor Holzmann, you've already said you're glad not to have an employment remit. You would rather focus on the worrying about the price of money rather than employment. Is that fair?
No, I think what I said is we have a price objective, inflation objective. And if this is, if you're able to work on this, we're allowed to support other policy objectives, which can be employment, which can be also a green agenda. If they have the instruments, can do so. So it's not that we have other objectives. There we have many objectives, and there we follow the political leadership to support it, but not if it's to the detriment of price stability.
Okay. I've had an excellent question that tries to draw the threads together we've been discussing today. What is the perfect sequencing of measures proposed? Investing, green, fiscal consolidation, monetary policy, normalization, and debt write-offs? That's an excellent question. What order should we do those things in? I'm going to start with you on that, Bill.
Well, I'm of the view that we have all of these systems that are under stress. you may remember the line from Tolstoy, I think it is, Anna Karenina, the opening line, all happy families are the same, but all unhappy families are unhappy in different ways. You need a lot of different things to come together in order to achieve happiness or sustainability. And the problem at the moment is that all of the major systems are under stress. And so I guess the conclusion that I come to is that we really have to try to deal with all of these issues at the same time. And at the very least, when we conduct a particular policy with the objective of stabilizing a particular system, that we should do so in full recognition of the implications that it might have for other systems. Because the honest truth is that there's a lot of trade-offs here. So we were talking earlier on about more growth, for example, as a solution to the debt sustainability problem. But if more growth simply aggravates the environmental difficulties, then we may have created an even more difficult. So you see what I mean, that I think we really have to approach all four of them.
And if I really pressed you to sequence them, so for example, you might want to solve debt levels before you normalized interest rates for obvious reasons. If you were really forced to sequence them, what sequence would you use?
Well, I think in the first instance, what I would, dealing primarily now on the economic side, but keeping the environmental and the inclusion political stuff firmly in mind, I think orderly debt restructuring, as I said before, is where I would start. Then I think I would move to monetary policy normalization. And I know a lot of people will find that difficult to handle. But I think the worries that you would have about temper tantrums and the debt trap would be of less consequence if you'd already taken steps to resolve the debt overhang problem through orderly restructuring. And it's only then, I think, that I would turn to fiscal restraint, because I think as is becoming increasingly recognized, most governments, even if they are on an unsustainable path, and you can do this intertemporal accounting stuff that shows technically that most of the governments, in fact, are already on an unsustainable path. The access to the markets continues to be open. And I think for most countries, and that probably applies even to the peripheral countries in Europe, if given the promise of central support in some fashion, whether from the ECB or from the EU, whatever, and that seems to be the recent trends in the EU, that there is still market access, and we should use it until we've resolved these other problems. And I know that there are dangers associated with all of these possible permutations of policy moves, but it seems to me that orderly debt restructuring, monetary renormalization, then fiscal restraint is the right way to go. And we can gain some room for maneuver on the fiscal side by borrowing at long duration when we have the opportunity, and by giving credible indications of how we intend to go back to debt sustainability. So things like the debt anchor or the debt brake, clearer ideas of which taxes we might move to in the end to resolve the fiscal problem. All of these things would be helpful in maintaining open access to financial markets for sovereign borrowers. So that's the order that I'd choose, but I recognize that there are difficulties in all of them.
That's very clear. Governor Holzmann, I wanted to go over to you. Which of these things would you do first? Which ones most worry you? Would you like to normalize on debt, for example, monetary policy, environment, fiscal?
My approach would be to add one pillar, a fifth pillar, which Bill didn't mention, which I consider crucial, which is the pillar of productivity growth.
Right.
Because my economic thinking is that our problem of monetary policy has its foundation in the continuous fall of the real interest rate towards zero, which has its origins in the productivity fall over the last decades. And unless we solve this problem, we won't be able to move back to a normalization of monetary policy. If we are able to solve the productivity plus also the supply-demand differences, north-south, oversupply of capital in the north, undersupply in the south, we won't be able to solve the first two problems. If you're able to solve those two, my take is then inflation as well, the financial, the debt problem, as well as the environmental problem can be solved. And particularly if you're able, and here I'm to say fantasizing that it's possible to use the green agenda to come in with productivity growth. So to have something which solves both the green problem and or contributes to it and solves the productivity problem. And hence to have a win-win situation which makes the contrast and the conflict, which Bill referred to, less stringent.
Okay. Interestingly, before the Corona crisis, we were talking numerous times with the Italian central bank and also members of the government. In fact, they say exactly the same thing. And that was before Corona, that productivity is the way out first in their particular case. If you're asked to sequence, Pierre, a quick word from you on sequencing those remedies.
I guess I don't disagree with Bill. I might put fiscal before monetary, if only because if I were a central banker, I'd want the fiscal authorities to show what they can do credibly before I commit to something, but I don't feel very strongly about that. I do briefly want to underscore that Bill is right, that the trade-offs are such that I'm reminded of a few decades ago of transition economies and went out the window because what worked in one country didn't work in other countries.
Denai, final word from you on sequencing. I know you in particular have a long-term horizon in terms of sustainability and those issues which need urgently addressing. Would that reorder your priorities in terms of these remedies?
Thanks, John. Yes, I'd like to go back to something that Bill said at the very beginning of our session. He said, I don't want to sound alarmist, but the global economy and humanity is at a more precarious place than many people think. And I think thinking about normalization when we know that the economic, political, environmental policies that we've had in the past do not work is the wrong place to start. We shouldn't be thinking about going back to normal. What is normal? I'm not saying we should be throwing out of the window all the wisdom that we've gained, but I think we do need to radically rethink some of the policies that we've had. And I think putting the environment and sustainability at the heart of what we do going forward, using this crisis, this trigger, as Bill described it, as an opportunity to move into a more sustainable economic system is the key priority for me. And I think working around that in terms of what monetary policy does, we had a good discussion about should central banks be fixing the problems they are thought to have created. I think it's not a question about do we have the tools at our disposal. I think it's a question, should we be measuring ourselves and our success against the task that is needed, not what we can do about it. Because what we've seen with central banks and how they've taken up the sustainability agenda is something very impressive. It's something that they've done within their mandates. They've interpreted as a source of financial instability. And I think the same can be done for other social issues, environmental governance issues. And I think the same framework can be used in allowing central banks and enabling them to use the tools that they have to move to a more sustainable economic and financial system. They are very powerful institutions, and that's what we should be measuring them against.
Okay, thanks, Denai. We're going to wrap up very shortly, but I've just had an excellent question in on debt restructuring and the sequencing question. I used to spend quite a lot of time thinking about capital markets in my previous role, Euromoney. If a debt restructuring is on the horizon and known to be on the horizon, won't sovereign bond investors run for the hills? That will then exacerbate the problem for that borrower. What would you say about that, Bill?
Well, I think it's like many other policy suggestions. It's like revenge should be taken cold. That perhaps one's almost doing a disservice. I agree with you by talking about the about some of these things that are inevitable, because it makes people then take steps to protect themselves that actually leads to the problem that you're trying to avoid. I'll be honest. I have no answer to that, other than to say one hopes that you can do a lot of the work sort of behind the scenes, and in a way that doesn't sort of alarm the people that are watching what's going on. But the fact of the matter is that if the alternative is disorderly restructuring as opposed to orderly restructuring, we really do have to get on with making sure that the orderly part of it is possible.
I think we're saying that would have to be a goose that's plucked without hissing somehow. Would you agree, Governor Holzmann, if you announce a restructuring, that's simply going to immediately make the problem much worse for the sovereign issuer in question?
I agree with Bill. Announcing a debt restructuring is not a good idea. You can do it under crisis if you close it over a long weekend and have everything in place and come out with a result, and have limits on selling and buying in place. Announcing it, simply everybody runs towards the exit and the exit is crowded. Okay,
that sounds like a pretty tough and difficult thing to do. It's much easier said than done, I think. Lots for us to think about. I'd like, Ellie, if you could, to run the poll again. As we head to the final minutes, to see if you agree with this question. On balance, is super accommodative monetary policy damaging the economy? Yes or no? So if you could all vote now. I think, Ellie, we had 50-50 last time. I think we've now, people have decided it is less damaging than they thought when we started talking. Thank you very much. That's very helpful, everyone. Thank you for the, we can drop that. Thank you very much. Thank you to everyone for listening. I don't think we've got any easy answers here. Certainly, I think we've asked a lot of the right questions. There are some difficult choices to be made, as you said, Bill. I don't think, it seems to me that people are quite ready to make them yet, but it sounds like we need to discuss what exactly they will be a bit more before then. So I wanted to thank you all very much for listening, and thank you to all the panelists, Bill, Pierre, Denai, Governor Holzmann. We greatly appreciate your time this afternoon. Good afternoon, good morning, and see you next time. Thank you very much.
Thank you.
Thank you.